We need to understand that risk and return are related. When we think about investing, we naturally think about the risk-return equation. How much risk am I prepared to take to earn a certain level of return? I think we all understand that there is no such thing as an entirely risk-free investment. Even cash and government bonds aren't risk-free. And it's a principle of financial economics and how financial markets work that if you take more risk, you should earn a higher return. It's not guaranteed, of course, that's why it's called risk and not certainty. Equally, if you don't need such a high level of return, you can opt to take lower amounts of risk and still have a successful outcome. History shows that the long-term investors have been well rewarded for taking the risks of the stock market. For instance, £1 invested in cash in 1976 would be worth approximately £16 today, and £1 invested in government bonds approximately £21, whereas £1 invested in the stock market would now be worth £160. But of course the value of your stock market investment will have fluctuated along the way, much more so than the investments in cash and government bonds. You've taken more risk, but over the long term you've been rewarded with more return. The key to understanding risk and return for investors is therefore really twofold. Firstly, you need to put risk and return into context. For an investment portfolio, that means before diving in and investing, a common mistake we see a lot in practice, take a step back and first develop your financial plan. A good financial plan will help you decide and prioritise your financial objectives, and as part of that, help you determine the level of returns you need for your plan to be successful. We sometimes call this knowing your number, how much financial assets you need to be invested for you to achieve your goals. A good plan will therefore also help you understand your willingness and ability to accept the level of risk to deliver those targeted returns and help you stay the course at the time when the going gets tough. Secondly, investors naturally focus on risk, but investing is actually more about dealing with uncertainty. And there's a big difference between risk and uncertainty. Risk is where we know the odds of something happening, like you roll a dice to get a 6, or you decide to go red or black at the roulette table. With investing, we never know what the odds of something happening are precisely. For instance, we know on average that a 20% plus drop in the stock market has happened roughly once every 7 years in the last 20, and maybe once every 10 years in the last 40 years or so. But that doesn't tell us very much about when the next 20% plus market drop may hit in the future. There's so much uncertainty that we can't estimate the odds very well. So investors need to think about investing more in terms of uncertainty than in terms of risk. So just completing the usual risk profile questionnaire for your portfolio won't really be that helpful. All this means having to accept that there will be periods of going through lots of uncertainty, and investors should therefore focus on managing the risks in their portfolios and not the returns. Which is why understanding your risk and return trade-off is so important, and having the context of a proper financial plan. You should be aiming to take enough risk to achieve your goals, but not more risk than your ability and willingness is to stay the course. Otherwise, you'll just end up bailing out.